Hello, and in this video, I'd like to review discussion questions or review questions for Chapter 4 of the REC book. Again, we're in the third edition of the REC et al. Book. Question 4.1, last month, the local government collected property taxes, collected gas taxes, reserved for highway expansion, received monetary contribution from an estate. The contribution is to be held intact, but earnings are reserved for purchase of a special collection of historical books for public library. What governmental funds should be used to account for these items? Property taxes are used for general government operations, so they will go to general fund. Gas taxes will go for, they're specifically collected for highway expansion. So this is going to be a special revenue fund, and monetary contribution from an estate will be a fiduciary fund, and specifically it will be in a permanent fund because the earnings are the principal is to be held intact, and the earnings are to be used for a specific purpose. That's discussed on the top of page 148. Question 4.2. When preparing the statement or schedule of revenues and expenditures and changes in fund balances and budgetary basis, how are the encumbrances outstanding in the year-end treated if they're to be honored in the coming year? So the encumbrances are, remember, special money already set aside for a particular purchase. Maybe the purchase order has been created, for example. The transaction itself hasn't occurred yet, the exchange hasn't occurred, but the money has been set aside. If the intent is to honor those encumbrances in the end of the year, while normally encumbrances account is closed in the end of the year, if they are to be honored, the encumbrances account will not be closed in the end of the year, as opposed to all the budgetary accounts will be closed. So again, if the encumbrances are to be honored in the end of the year, the outstanding encumbrances journal entry is not reversed. Question 4.3. In many cases, property taxes comprise a significant source of revenue and cash receipts for the government. If property tax cash collection typically occurred during 1 or 2 collection periods, how do governments manage working capital needs? So the textbook talks about the fact that if the money from property tax collection doesn't come in very quickly, the government essentially could, but the government needs the money up front, the government could essentially borrow money and issue what's called tax anticipation notes. Tax anticipation notes are notes essentially guaranteed with, or secured with, I should say, property tax collections. And it's just a way, it's sort of like a line of credit in the commercial space in a sense. The government borrows money, essentially gets a short-term loan to fund its operations. All right, next question is 4.4. Explain why some transactions for governmental activities and government-wide level are reported differently than transactions for the general fund. Give some examples of transactions that will be recorded in the general journals, on the general fund, on the governmental activities, at government-wide level, or both. Again, the general fund follows modified accrual basis of accounting. Government-wide financial statements follow accrual basis of accounting. So any sort of non-cash GAAP transactions that would be recorded on the government fund, on government-wide financial statements will not be recorded on general fund financial statements. The most direct example is depreciation. We talked about that earlier. Or, for example, impairment transactions, asset impairment transactions will be recorded in government-wide financial statements, but not in the general fund financial statements. That answers part B. Part A, budgetary transactions are only recorded in the general fund, right? They're not recorded on the government-wide financial statements or encumbrances. And pretty much any kind of transactions that involve cash, cash-based sales, or cash-based collections of taxes, or cash-based expenditures of money will be recorded on both sets of financials. All right, for question 4.5, if the general fund of a certain city needs 6.72 million of revenue in property taxes to finance estimated expenditures next fiscal year, and historical experience indicates that 4% of the gross levy will not be collected, what should be the amount of gross levy property taxes? Well, you want to make sure you get 6.72 million, and you know that you won't collect 4%. So 6.72 million is essentially 96% of it of what you need to bill, right? So therefore the levy should be 6.72 million divided by 0.96 or $7 million. That's question 4.5. Question 4.6, why might differences exist between the amount of property tax revenue recorded over the current year by the governmental funds and the amount of property tax revenue recorded for the current year for governmental activities in a given year? Well, again, accrual versus modified accrual basis of accounting. Governmental activities of government-wide financial statements will record the tax receivable for the whole amount of billed and recognize the revenue on the GAAP basis, with the allowance for uncollectibles. The general fund, governmental funds, financial statements will follow modified accrual basis of accounting, which will follow 60-day availability rule. Meaning that they will only recognize revenue which is expected to be collected within 60 days after the taxes are due, right? So any revenue which will not be collected past 10 might be collected later, will be recorded as deferred inflows of financial resources, unavailable revenues, right? So remember, modified accrual basis of accounting is essentially kind of like cash basis of accounting in the sense that they'll treat anything as revenue that's either already coming in cash or is expected to come in cash very, very shortly.
You've been reading for some time now, but you haven't stopped to practice.
And that is the kind of what the difference is. Question 4.7, explain why some governments may account for inventories and supplies using the purchases method, the general fund, and the consumption method at government-wide level. How would the amount reported for expenditures in the general fund compare to the amount of expenses reported at the government-wide level if two methods of inventory accounting are used? So page 136 of third edition of the Record All book discusses the differences. And so purchases method of accounting. Under using the purchase method of accounting, it talks about on the bottom of page 135, expenditures for supplies equal to the total cost of supplies purchased during the year, even if the amount of supplies consumed is less than or greater than the amount purchased. So in other words, under the purchases method, you essentially expense whatever you pay for purchases, right? That's not what we would do under the regular accrual basis of accounting. Under the regular accrual basis of accounting, you would follow the consumption method, which is, you would only expense what was consumed during the period. So government funds or general fund accounting will use purchases method because it's modified accrual basis. It treats the actual amount of purchases as the expenditure. Whereas under the consumption method for the accrual basis of accounting for government-wide financial statements, you will use consumption method. So it says here that GASB standards require the use of consumption method for government-wide and proprietary fund reporting, right? Proprietary funds, of course, also follow accrual basis of accounting. And the expenditures under the general fund would differ from the accrual basis for under the purchases method because they would be higher, at least initially, because you would treat it as, put the full amount of purchase as an expenditure, whereas under the consumption method, you would only account for the amount of inventory used, which is what you're used to from your basic introductory accounting class. All right, 4.8. While governments are not required to issue interim financial reports, what role does interim financial reporting play in the local government administration? It's discussed in the end of the chapter. And so essentially, interim financial reporting talks on Appendix B on page 154. Although there is no requirement for external interim reporting, all state and local governments should prepare interim financial statements for internal use of administrators and legislators. The frequency and nature of interim reports are at the discretion of each government. The minimum quarterly budgetary comparison schedule should be prepared showing actual revenues to date compared to budgeted revenues and actual expenditures and outstanding encumbrances that they compared with appropriations. So essentially, interim financial reporting is an important budgeting control tool, which government should still use internally. Question 419, how does permanent fund differ from public purpose trusts that are reported in special revenue funds? Discussed on page 148 on the top. Permanent fund, of course, is a fund which is typically endowments are maintained in them, right? Endowments are gifts where one could use in earnings for some particular purpose, but not the principal. So, for example, scholarship funds often follow that. Or I have an Ernst & Young chair that was gifted to the University of Baltimore. It's an additional stipend that I get paid in addition to my salary. But the body of the original gift, the principal, cannot be used to pay me. Only the earnings that the money is invested in from the investments could be used. Now, if the gift stipulates that both principal of the original gift and the earnings could be used to pay for the mission on that particular fund, then you account for the gift or for the money in a special revenue fund, not in the permanent fiduciary fund. So the difference being, of course, that permanent fund it's typically a fiduciary type fund that where only earnings could be used for a particular purpose. And in this case, public purpose trust implies it's for the benefit of citizenry, not particular citizen or particular party, but not the principal. Special revenue funds you'd account for if you can spend both earnings and the principal. Question 4.10. Name 4 classes of non-exchange transactions defined by GASB standards and explain revenue expense recognition rules applicable to each class. That's not something that you need to know in great detail, but illustration 4A, it's an appendix A41. Illustration A41, summary chart, classes and time of recognition, non-exchange transactions. Just remember the definition of the non-exchange transaction. Non-exchange transaction is when a situation when the government gets something but doesn't have to do anything in return, right? So it's defined on page 152. Non-exchange transactions are defined as external events in which government gives or receives value without directly receiving or given equal value in exchange. So, one classic example of non-exchange revenue would be taxes, right? Because the government levies taxes, collects taxes, but doesn't have to do anything directly in return. So on page 153, you have this exhibit A41, talks about derived tax revenues, imposed non-exchange revenues. So, for example, derived tax revenues would be the revenues deriving the amount from something else. So such as, for example, sales taxes, personal and corporate income taxes, because the amount is derived from your income, or the amount of derived from the value of the sale. Imposed non-exchange revenues, property taxes, most fines and forfeitures. Government mandated non-exchange transactions would be the third typical example, where federal government mandates on state and local governments and voluntary non-exchange transactions, certain grants and entitlements, most donations. So, this exhibit kind of summarizes the different, accounting issues here. For derived tax revenues, because it's the most relevant one to us, you recognize them as an asset on the period when underlying exchange has occurred, when the resources are received, whichever is first. So either when the taxes are levied or when the taxes are physically received, whichever is first. If you follow modified accrual basis of accounting, of course, for general fund, for governmental funds, any taxes which are not available are classified as deferred inflow on financial resources if they're not available within 60 days of the collection date. Revenue is recognized in the period when underlying exchange has occurred. When modified accrual accounting is used, resources also should be available. So, take a look at table for 8.41. And again, for non-exchange transactions, remember that the key element is taxes. Question 411, government reports deferred inflows of resources, unavailable revenues, and general fund balance sheet. What are deferred inflows of resources? When are they recorded? I already mentioned it a couple of times. It's a situation where, let's say, classic example from property tax levy, government levies taxes, but doesn't expect some of that taxes to come in within 60 days of the due date or of the deadline. So then it gets classified as deferred inflows of resources, unavailable revenues. And that concludes our discussion of question 4 review questions.